Having me. I appreciate you allowing me to present here. First, a disclaimer, really very quickly: options are not suitable for all investors. Options involve risk. I'm not registered with the SEC currently, although I was for many years. And everything I say is for educational purposes and should not be construed as market advice. Today's presentation is how the top 1% trade options. And I'm gonna show you something that's actually fairly simple, but it's something that people don't know, and we'll get into that. And I'm gonna actually show you proof. So I'm gonna make a lot of big statements today, but I'm gonna actually show you proof of everything that I'm saying. And believe it or not, I'm a big believer in no Greeks and no implied volatility. So that should wake people up right away. We're gonna answer these 6 questions throughout the day. Who am I? What is OptionsGeek.com? Why am I doing this? More importantly, and why is everyone confused? What are they confused about? And then what's the answer? All right, so how the top 1% trade options. I'm hoping that you can actually give me the full 45 to 55 minutes. Oftentimes I start a little bit, it could seem simple, and this is an advanced option strategies day. So I want you to understand that it doesn't matter if you're a beginner or an expert. I guarantee you learn something because I guarantee that you don't know the answers of the questions I'm going to pose you. So here we go. Again, Felix Frey. I graduated the Wharton School at the University of Pennsylvania in 1995. My first job was at Swiss Bank O'Connor. O'Connor was essentially known for 2 things. They were known for making a lot of money in the options pits and in the options market, and they were known for having the best options trading program on Wall Street. I started there in 1995, was eventually recruited away to what became Bank of America. It was there that my experience really took off, and I started dealing on a day-to-day basis, advising and trading against some of the biggest guys in the world. Names like George Soros, Bill Ackman, Carl Icahn, Steve Cohen. These are the top 1%. These are the big guys. Even Warren Buffett, except he generally trades once every 3 to 5 years. After that, I was recruited at options as a head options trader at Scoggin Capital Management. Scoggin is a prestigious hedge fund run by 2 of the best risk managers over the last 30 years. They taught me a tremendous amount, and sitting next to them, I was able to absorb exactly how they did it. So you're listening to someone who's actually been right next to some of the biggest guys in the world, okay, and dealing with them on a day-to-day basis, so you understand. Now, I took my experience and translated it into a groundbreaking options trading system. I call it 3 steps to profit. Okay, it's groundbreaking for several reasons, which we'll get into. But step 1, let's talk about the education. It's brand new. It's brand new education, brand new options education, new formula, simple to understand. Okay, it's great education, but in order to make it great, I had to make it practical. So step 2 is this tool that I created that thinks just like the top guys in the world. This tool is a game changer, and I'm going to show you how it works in a moment. Lastly, step 3 is once you have the education and you understand options, then you have this tool that could help you think exactly like the top guys in the world. Then you actually have to find trading ideas. I'm going to show you what it means to find great risk-reward trading ideas. Okay, so the question is then, Felix, why with this gold standard of experience am I doing this? Why are you here? Okay, I'm doing this for a very specific reason. But let's start with the Black-Scholes formula in 1973. Real quickly, the Black-Scholes formula looks like that in the upper right-hand corner. That's where you get the Greeks and implied volatility. Okay, in the 1970s, when it was founded the formula was founded in 1973. In the 1970s, there weren't that many people trading options. Okay, today there's millions of people trading options. Throughout my career, I realized that there was a simple problem out there. Okay, but it was a big problem. Most people are confused. Okay, so I took my career and translated it into Options Geek to give people the answers they're looking for with a new formula, new concepts, and I keep it simple. Why am I doing this? Because I think this is the next phase in the evolution of the options industry. Okay, I'm going to change. I'm disrupting the options industry as it stands, and I'm trying to open the door for the millions of other people that still haven't even used options or are too confused to try them. Now, it's very important that you understand this. If you're talking, if we're going to understand how the top guys trade, then we have to understand this. And this is where the industry has failed you. Okay, they have not made it clear that there are 2 types of options traders. There's a volatility trader and there's a directional leverage trader. So let's briefly talk about a volatility trader. The volatility trader is the trader that focuses on the Black-Scholes formula. They focus on the Greeks. They focus on implied volatility. Okay, they are actively trading to remain neutral on the directional risk of the underlying asset, usually the stock. In our terms, we're talking about the stock. Okay, they profit on how the stock moves, not where it actually ends up. How the stock moves is how they profit. Okay, that's much different from the directional leverage trader. The directional leverage trader is using options to profit from the directional movement or lack of movement if you're selling in the underlying asset. They profit mainly from where the stock goes, where it ends up. Okay, that's what's dictating the profits for the directional leverage trader. This is an important distinction if you're going to look at options, if you're going to trade options. Okay, now I want to give you a 30,000-foot view of the world, of the options world. Okay, here you start with the exchanges and the market makers. Okay, outside of that, you then have the investment banks. Okay, outside of the investment banks, you have this institutional customer. Okay, the customers to the investment banks. Then within the institutional customers, you have what's called these hedge funds. Okay, these hedge funds. Now, in the 1970s and 80s, this essentially was the market. This was the options market universe. Okay, today there's millions of average retail traders. It dwarfs the number of retail traders out there, average investor people out there, dwarfs the number of institutional traders and participants in the options industry. Okay, so the retail trader is massive. Now, let's take a look at the volatility trader in the market. The volatility traders in the market are very specific. They are the market makers. They are the people that work at the investment banks, where I used to work, Bank of America, Goldman Sachs, JP Morgan, Deutsche Bank, any one of those big top investment banks. They are trading volatility. And then within this small sliver of the hedge fund community is a few volatility traders. Maybe there's 25 to 50 that actually trade volatility. Okay, everyone else is trading directional leverage. Okay, including these hedge funds and the institutional customers. Okay, the investment banks, they're not trading directional leverage. The market makers, they're supposed to be trading volatility. Okay, they're trading the bid ask and volatility. Okay, it's important. This is an important distinction of who's trading what. Okay, now the hedge funds that we're talking about, Carl Icahn, Steve Cohen, George Soros, Bill Ackman, Dan Loeb, John Paulson, those guys are the guys you read about in the Wall Street Journal, you see on CNBC. They're trading directional leverage. It's important to understand that. Ken Griffin from Citadel, he's a volatility trader. D.E. Shaw, volatility trader. Big traders make a fortune, make a lot of money. They just trade the volatility. The retail trader, okay? The retail trader, also a directional leverage trader. 99% of retail traders are directional leverage traders, okay? There's a very small group that maybe used to be market makers, or they want to trade this delta neutral way. It's a very, very, very small community, okay? Now, here's the issue, okay? The education, the available education that everyone is looking at all stems from market makers and the investment banks. In fact, right now, the education is supported essentially by volatility traders. Okay, the teachers of volatility traders. It was created. A lot of the education stems from where I began working at Swiss Bank O'Connor, the O'Connor trading program. All of that education is really matched up with the volatility trader. Okay, and that is the industry's fundamental flaw. There's a mismatch because you now have, in the 1970s that was great, but now in the year 2020. Millions of new investors are in the game, and they are trading differently than the market maker. They are trading differently than the people that work at the investment banks. The retail traders would like to trade, most of the time, they want to trade like the biggest hedge fund managers in the world. These guys, the guys in yellow. Again, I call these guys the top 1%. I nickname them the sharks. And there is no education out there that teaches you how they trade. None. You won't find it anywhere. Not on video, not in a book, anywhere. You're not going to find how they look at the world and how they are trading options. They trade it in a very specific way, and we're going to talk about that in a second. I created optionsgeek.com to give the average investor, the millions of investors out there, the answers to many questions they have, but specifically a couple that I'm going to get into right now. And I teach them how to trade just like these hedge fund guys, how to think about options just like these hedge fund guys. So let's talk about how do the top 1% use options. I'm going to say 4 things here. Okay, they buy options, first of all. They try to avoid spreads, all type of spreads they try to avoid. They try to avoid calendar spreads, iron condors, butterflies. They try to avoid even call spreads or put spreads. Okay, they are trading, they are buying options, and they're buying out of the money options. And when they buy options, they are focusing on 150 to 400% returns. Now, what does that mean? When they buy an option, are they trying to make 30, 40, 50%? No. You cannot call a hedge fund. You cannot call a hedge fund manager and ask them to see or offer them an idea and say, here's a great idea, you can make 50%. They're going to hang up the phone on you. They are looking for 150 to 400% returns. That's how they trade. Now, 90%, if I had to handicap it, 90% of the time they're buying options, and 90% of the time they're buying out of the money options. 10% of the time they might be doing a call spread or put spread. Maybe call it 9%, and 1% they're playing around with a butterfly or something like that. Okay, so these 4 things are very important to understand. Now let's talk about the problem. The problem, I've narrowed down the problem that's in this industry to 2 questions. Okay, and let's talk about those 2 questions. Those 2 questions revolve around essentially how the top guys in the world use options, how they buy options. And the 2 questions are, 1, when do I buy options? Okay, and 2, which option do I buy? Specifically, which strike do I buy, and why is that the right strike? Now, I am going to make a big statement here and tell you that 99% of all investors, including the people on Wall Street, 99% of all investors can't answer these 2 questions that I posed to you. When do I buy options, and which option do I buy? Okay. To illustrate what I'm saying, I want to show you an example. Here's just something I took recently, AMD. Earnings are in late July. Stocks had a big run since early October. Looks like it's developing this flag. If it breaks through here, it probably goes higher. Quick idea. Through technicals, you can come up with ideas through various different ways: technicals, fundamentals, quantitative data. Okay, once you get the idea, you then have to make a choice. Okay, just because I have an idea, that doesn't make it an options idea. I have to then have the understanding of whether or not that idea is an options trade or it's a stock trade. It's very important to understand when to use options or when to use stock. That's question number 1. Once you decide, you know what, this looks like an options trade, then you come to the options chain. Okay, you come to the options chain. Now, AMD, in this scenario, I chose October because you get the earnings in late July. So I got my expiration, the timing. Now I'm looking at 16 different strikes. And the question that everyone has is, how do you actually choose which strike? How do you actually choose? And not only how do you choose which strike, but then I want you to prove it to me. Because if you can't prove to me why you're choosing one strike, then you have to admit to yourself that you are guessing. You are guessing at which strike you choose. Now, options, I want you to think about this board is like a probability game. It's a probability board. If you're guessing at any probability game, it's likely that you lose over time. If you're guessing at which strike you're using, you will lose. You will go down a path of guaranteed losses over time. Okay, so the question stands, how do you actually buy and choose the right option? And how do you prove to someone like me that it's the right option? Now, you're going to get answers. You're going to get a lot of answers. If after today you understand what I'm saying, I'm going to ask you to go out and prove it to yourself if you don't believe what I'm saying. Go ask any option expert you want. How do you actually buy one, and how do you prove to me that's the right one? What you'll get is, here are some of the answers. Buy the 70 delta in the money option. I've heard many people say that. That's been going around, I guess, for the last year. Someone is saying that. How can it always be that I buy the 70 delta in the money option? It doesn't even make sense. Every time I have an idea, if I think AMD is going up, regardless of where I tell you I think it's going, the 70 delta option is the right one. That's not correct, okay? The second answer you'll hear, buy the option with the most gamma. Well, the most gamma option is the at the money option. And just like buying a 70 delta option is not right, always buying the at the money option is also not correct. Buy the out of the money option, you'll hear. Now it's starting to get closer to the answer. But the question is, which one? There's a lot of out of money options. Now we've narrowed the at the money, the AMD options that I showed you down to 8 options. Which one? Which is right for you? Clearly, just buying the out of the money option is not the right answer. The next thing you'll hear is, well, I buy low volatility options. Well, in the last 3 months, volatility has been at its highest it's been in 20 years. And you still see very large options trades. You still see the best guys in the world come in to buy options. Clearly, they're not buying low volatility. So that's definitely not the answer. Just look at the last couple of months, okay? Lastly, you will hear as an answer what I call deflection tactics. Now, deflection tactics are either they ask you ask an expert the question, they ask you a question, and they all of a sudden start going on the offense by asking you. Sometimes you hear, I don't buy options because blah, 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 blah. Okay, well, I always ask the expert who I'm talking to and say, well, if you don't buy options because of that means that you understand how to buy options. So can we focus on the understanding of buying options? And can you prove to me that you understand? I don't get an answer. You have to worry about the implied volatility. You have to know the Greeks. What do I have to know about implied volatility? Show it to me. What do I have to know about the Greeks? Show it to me. Give me an example. You can make up an example. Show it to me. Prove it to me. It's not there. You're not going to get the answer there. Or they say something complicated meant to confuse you. This is a great one, right? Or they'll just simply say, you know what? You got to learn the Greeks. Go learn the Greeks and come back to me when you learn the Greeks. Lastly, they'll say something that completely ignores the question. Now, it's one thing for me to say all this, okay? But now I've made this big statement and I want to prove it to you, okay? I've been out there for the last year proving it to people that, you know what? The industry doesn't give the answer, okay? I have 3 points of proof here. 1, the Options Industry Council. 2, comes from a market maker. And the 3rd comes from an investment bank head derivative trader who also worked at a top hedge fund. Okay, so let me just show you the first, the Options Industry Council. They are the industry, okay? The Options Industry Council is supported by market makers, it's supported by the investment banks, okay? And it's supported by the hedge fund volatility traders. Here's their lesson on buying calls. In the first page, 31 pages, but in the first page with this makeshift options chain, which is fine, they say, after discussion with our broker, we decided to purchase one XYZ June 80 calls for a quoted price of $8. That's interesting, no? I want to know what was in that discussion because they never really tell you, right? And I want to know, how did the broker choose? And what's even more interesting is that the OIC actually teaches the brokers. So one broker who doesn't know is asking another broker who learned from this class. Broker asking broker, all learning from the same page 1. Ask your broker. It's circular. Clearly, they don't give an answer. Now, on Reddit, here was someone who was an options trader at a major proprietary trading market maker in Chicago. Okay, he's out there doing the right thing, answering people's questions, helping out. I jumped in, and I normally don't jump in, but I jumped in and I tried to explain my case and asked them the simple question. I'll let you read it. I think they'll replay this video so you can actually read it. I won't read the whole thing. But essentially, I asked him, I started pressing him on my question. Hey, how do you actually choose the right option? How do you have 200 people, asking you questions. How do they choose? Can you explain to them how they choose? He basically wrote back, you're correct. I don't know the answer. I haven't studied options models enough to know. And as a market maker, it doesn't matter to me. Thankfully, ha. Well, that's great. That's all I needed to know. He was actually pretty humble. I don't go out there trying to make someone, I don't want to go out there trying to make people feel like I'm smarter than them. I'm not. There's many people that are out there that are much smarter than me, and they use options. I'm simply trying to say there's a big problem in the industry, and people don't know the answer, and people are scared to ask the question even. You have hundreds of people on Wall Street scared to ask the question because they're supposed to know. But I know that they don't know the answer, which brings me to the next person. This guy here is the head trader at an investment bank. Okay, He was longtime derivative trader who was the head trader of equity derivatives at several major investment banks. It doesn't get much higher than this guy. Okay. He throws me a backhanded compliment. So I immediately email him back. And again, you can read our discussion. And I start challenging him. Okay. He's coming back at me and he starts with one of these tactics. He says, look at it from the perspective of a simple delta neutral back spread. Now, for the average person, a simple delta neutral back spread is going to scare anybody away. Okay. The average investor is not even going to know how to respond, but I do respond. But I wanted to point out, look at these investment banks. These is Nomura, Smith Barney, Solomon Smith Barney, and Millennium. Millennium is one of the top hedge funds in the world. So this guy, okay, I left his name out, but this guy, you don't get much higher in the options food chain than this guy, okay? And I'm simply just asking him, hey, can you do me a favor and can you answer these questions? They're pretty simple. You came at me. I'm just asking you to answer these questions. I don't get an answer, okay? I don't get what I'm saying. But what I do start getting, as you'll start seeing here, is this deflection tactic, because now he realizes that I know what I'm talking about. He tried to deflect me. I deflected him back by saying, what are you talking about? You know, why don't you just stick to the question and answer? He starts saying, it certainly appears that you are for real, which means he thought I wasn't an expert. And then he starts with this. Let's start with the fact that I am a delta gamma vol skew guy and typically trade the underlying for delta bets, but it's definitely not my strength. I asked this guy the simple questions I posed to you. He is a top expert in the world. And now he's backtracking, telling me it's not his strength, what I'm asking him. Okay, which I can tell you the conclusion is that he did call me. We did speak. And we spoke for a few minutes, and I wouldn't leave him. I wouldn't go on to answer or talk about anything else. And I gave him the answer, but I wasn't going to give him the answer unless he told me that he didn't understand. Because I've spoken to hundreds of experts, and after telling them the answer, they tell me, yeah, of course, I knew that. Well, I'm here to tell you that they don't know. And here's proof from a guy who is a top expert in the industry. Now, some people say to me, well, Felix, there's a lot of ways to use options. And I say, you're right. You're right. There's a lot of ways to express your views. But you know what? If my son wanted to play in the major leagues, and I was teaching him how to pitch, which he's only 8 now, and I do teach him how to throw a ball, I'm not showing him how to throw a ball like this. Now, this guy is doing this submarine type of pitch, okay? You can make it into the majors. Clearly, he did, okay? However, I'm going to teach him how to throw a baseball the traditional way, like the best guys in the world. The best guys in the world. You want to be a pitcher in Major League Baseball? You have to, in general, pitch the ball like a Roger Clemens, a Hall of Famer, Nolan Ryan. They pitch the ball holding the ball behind their ear, using their legs with a form. It's a very specific way they use it. Options is no different. The best guys in the world do it in a very specific way. That's what the education I teach, that's what it shows you. Now, so the question is, how do you get the answers? How do the best in the world do it? Let's get to it, okay? Well, the best guys in the world, they don't like to guess, okay? They want certainty, okay? They want certainty, and the only certainty they're going to get is in 2 places. They're going to get certainty in where the option is priced today. What is the market price for the option right now, okay? That's certain. The market on the screen is 120, 130. I can't change that. It doesn't matter. It doesn't matter what a model says, or a model says it's worth $2 or it's worth 50 cents. It doesn't matter. It's worth what someone is willing to pay for it right now. $1.20, $1.30. That's the market. That's what it's worth. That's certainty. That's what I will need to pay in order to buy the option. Now, the next thing the next certainty that they look for is, if I have a target stock price and I hit my target stock price, then there is a minimum amount that option is worth, and that's called parity. And that is also certain, okay? That is also certain. So I have a target stock price. I know for certain that that option will be worth X in the future. The price you pay today, the price they're looking at paying today, is their risk. The reward will be in the parity, less the price they paid, okay? So that's their reward. They are doing a risk-reward analysis on that trade up front. They are looking at what they are risking, what they think they will make, and whether or not that is good for them. whether or not that's something they want to actually trade. That's the analysis right there. Now, I want to show you, and I kept it simple, but I want to show you now why implied volatility is not going to matter. Because most people say, oh, you want to buy, implied volatility is going to tell you whether it's cheap or expensive. Sure, in hindsight, it might tell you, it's going to tell you that it costs more today than it generally did in the past. But that doesn't mean that something is cheap or expensive. This notion that implied volatility is going to give you the answer and you want to buy cheap options is wrong. It's absolutely wrong. Okay, what makes an options cheap, okay, is this analysis that I just showed you. Okay, so when someone is buying, for example, today, volatility is still very high, and someone is buying the option, he's not buying low volatility. He's buying on volatility terms. He might be buying a volatility that is high, but it doesn't mean that he thinks it's expensive. He might think that that's cheap. Okay, so implied volatility is not the answer. Okay, and to prove it to you, no hedge fund manager will do this analysis and say, I want to buy this option for $1 because I think it's going to 5, and I've determined that the risk reward is in my favor in that option. Okay, and then you tell me that the option volatility is 20% or 50% or 100% or 300% or 5,000%. It's not going to change my position. I think it's going to $1 or $5, and I determined the risk reward is in my favor. The implied volatility is not going to change my mind. Now, again, we're looking at options price. We're looking at our target stock price to determine the future options price at a minimum. But now I want to tell you why the Greeks don't matter. When you're looking at options, the way the top guys in the world think, the Greeks are not necessarily going to matter. Okay, so this is an advanced option strategies day. I'm going to go a little quickly here. Maybe you know this, maybe you don't, but an option is made up of 2 parts. The first part is parity, called intrinsic value. The second part is time value. Okay, parity is basically controlled by where the stock is. It's the in the money part of the option. Okay, time value. The only thing that the Greeks and implied volatility affect is the time value, the light green section of an option. That's the only thing the Greeks and implied volatility affect. Intrinsic value is affected solely by where the stock is in relation to the strike. So here's an option. Our 105 call with $100 stock. The option is worth $1. We think it's ultimately going to be worth $5, right? Our risk is here. Our reward is in here. Now we want to evaluate the risk reward. We assume that that's correct. Here's what I want to show you now. I want to show you the middle part of the story. The middle part of the story is as the stock is going from 100 to the target stock price, okay, which here is what we're looking at 110, okay, because the option, the parity is worth 5. I want you to notice how the light green and the dark green shading is changing as the option moves towards the target stock price. You see, at the very beginning, the option is mainly light green. By the time you get to the end and the stock is hit the target stock price, the option is dark green. Okay, now there is a little bit of this light green. Okay, there's a little bit of time value left, but it's very little. Okay, if you hit your target stock price, most of the value of the option will be the intrinsic value. Parity, time value will essentially be meaningless. To throw numbers at it, intrinsic value in the beginning is 0. At the end, it's $5. In the beginning, time value is the whole option. It's $1. But at the end, time value may only be a nickel. The Greeks are in that small sliver of light green. Okay, in that small sliver of a nickel. The Greeks, even if you got the Greeks 100% correct, which is unlikely, even if you got where the implied volatility would be, again, unlikely, then the Greeks and the implied volatility are only going to affect 5 cents of a $5.05 option. It's meaningless. It's meaningless. Now, people say, well, what if you don't hit your target stock price? Well, if you don't hit your target stock price, it's a great question, but that's more of a question on the stock side. It's not the analysis of the option that was wrong, okay? You should focus more on picking the right target stock price as opposed to worrying about how the Greeks are gonna move as the stock is moving up or down, okay? So this is an important screen and something important for you to understand, okay? That is part of the education that I provide and I give at optionsgeek.com. Now, to answer the 2 questions, when do they use options? They use options by isolating an event that will move their stock, okay? They have to have high confidence high confidence in their target stock price, in their analysis of the stock. Forget about the options, in the analysis of the stock. And when the out of the money option offers them great risk reward, that shifts the odds in their favor. That's when they'll use options. Now, how do they choose an option? They focus on the price of the option, like we said today. They focus on what the option will be worth when their target stock price is reached, and they analyze the risk reward of each strike to determine which one is the best option that gives them the best risk adjusted returns. Now, clearly, I didn't go through the analysis. That's what 3 Steps to Profit will teach you. That's the education that's been missing. Now, again, education, step 1, we've gone through this. That's what you got a taste of that right now and what I'm showing you. The tool, let's talk about the tool. It's a game changer. Let's talk about why it's a game changer. Okay, let's go back to AMD. We had this stock that we thought was going up, and now we have to choose. What I'm gonna need, what you need to actually buy options is an expiration date, a target stock price, and some confidence level on your stock analysis. Some confidence level on your stock analysis. Okay, I built the new options chain that basically becomes more interactive. It's interactive and it helps you choose the right strike by giving you the answer after you give it the information. Okay, so it's going to think exactly like the top guys in the world think. I've made it to think exactly like Steve Cohen, exactly like a Bill Ackman, exactly like a George Soros or Carl Icahn. You're going to give it your target stock price. I chose 75 here, and it's going to spit out an answer. That answer is the 52.5 strike. Now, if I change it to 83, it would move it to the 60 strike. What's interesting is that I actually also shaded the board. Okay, I wanted to show you where the top guys actually are looking for opportunity. I call this the window of opportunity. If you have a target stock price and high confidence, and you can move around the confidence level as well to have the pointer move up or down. But if you have this high confidence with a target stock price and the pointer lands within this window of opportunity, you have yourself a trade and you have yourself a thought process the same way that the top guys in the world think. And the 60 calls would be the best option to express your unique idea. Okay, no one can tell you an option is expensive or cheap. Only you can tell that only you have the ability to know whether the option is expensive or cheap, because only you are the determinant of where the target of your target stock price, of where the stock can go. These people that are telling you that the option is cheap because of back testing, because of this or because of that, well, they're just going back in time. Okay, today we're looking forward. We're looking at what the stocks could do. Basically, if you were looking back in time, you wouldn't be buying any option right now. Okay, you wouldn't, because it's too hot. And so the answer would always be the options are too expensive, because in the past, in the last 10 years, average volatility was 20, and today average volatility is 45. So don't buy any options today. That's not the answer. It's not the answer. What makes the answer is your ability to determine what the right target stock price, and then again, you can do it on your own with hand to paper, or I've built this tool to do all the iterations and the analysis for you. 3 Steps to Profit. This groundbreaking options trading system has this education, 50 plus videos with Q&A, transcripts, 12 hours of material. It'll have you done, I tell people, over the weekend. You'll have a good understanding. Now, are you going to be an expert? No. Clearly not. But you're going to understand a different way of looking at options. You're going to understand what no education out there teaches. Okay? You're going to understand how the top guys in the world think about options and how they choose options so that you can do it yourself. Okay, my education is for beginners, intermediates, and believe me, it's for the experts. The experts don't even know how to do this. And I actually coach many experts on the side privately. So I am telling you that it's for everyone because it's brand new. Now, the tool, I call it a game changer. Why? Because there's no more analysis needed, no more guesswork. I've simplified the whole process of options. Okay, there are millions of investors out there that have never used options, are scared to use options because they are confused and because they don't know how to answer, and nobody can give them an answer to 2 simple questions. Okay, the 2 questions: when do I use options and which ones do I buy? Now, I tell people this is one of Wall Street's best kept secrets, and people attack me. But then I ask them the questions and they don't know the answer. Or they say, of course, everybody knows the answers. And when I ask them, they don't want to give it to me. And it's fine. Maybe there are other answers. I'm telling you, this is the only answer that's available that actually shows you how to do it. So if someone else has an answer, they just haven't told anyone. And that's fair. I can live with that. But until someone does open their mouth, they can't tell me that there's another answer because there isn't. Now, the third part to 3 Steps to Profit is teaching people how to get ideas. I use unusual options activity. Now, there are many people that use unusual options activity. There are many teachers of unusual options activity. It's been around for a very long time. On Wall Street, many people are doing that on a day-to-day basis. They're seeing large trades. If you're sitting at Goldman Sachs, you are seeing who comes in the door. When I was at Bank of America, I was trading against the people who come in the door. I then could have a better sense of where the action is going, what's happening. In the education, 3 Steps to Profit, I'm going to show you where to find the right data, how to filter the data, how to interrogate the data, how to analyze the data, what to analyze. Okay, I'm going to take unusual options activity to the next level. I'm going to show you how to back out a target stock price. Okay, so when you see when you see a trade on the board or some screener or some alert showing you, you can then determine what that person was thinking. The guy who actually traded, where does he think the stock is going? I can get you close to a range. I'm going to also, in the education, show you clues that you should be looking at to find the best unusual options activity trades. Why do I say this? Because look, unusual option activity, the problem with unusual option activity is how to actually filter down the data so it's manageable. You obviously can't trade every single one. Now, I offer this for a one-time payment, lifetime membership to my education, lifetime access to the options tool, and I offer 1 free month of Winning Picks subscription. What is that? Let's talk about the Winning Picks, because it's one thing to say, okay, great, you showed me how to actually pick and choose and think like the top guys. How do I actually make money, right? That's what everybody wants to know. How do I make money? I lead with education, but then I show you a process. In Winning Picks, I have a monthly or annual service. The education is one-time payment and the tool one-time payment. My Winning Picks on a monthly or annual service, I charge on a monthly or annual basis. I offer 2 to 4 great risk reward trading ideas each week. They're easy for you to trade. I simply buy puts or I buy calls. In that Winning Picks, in the Winning Picks product, I also teach you how to risk manage the positions. Okay, another term for that is a trading plan. Most people don't focus on a trading plan. The trading plan is just as important as the actual trading ideas. So we focus a lot on that. Now, each week, these are some of the results from February right before the market crashed. We trade puts and we trade calls. We have a balance of the two. Okay, red is the shading for the puts. You see the dates, the ticker, the month, the expiration month, the strike, puts, call price, high dollar amount, which is the highest it reached, and a high percentage. I also give you this would be a Friday, that would be today, which would be a Friday, or I'm sorry, tomorrow would be Friday. So I would give you the price tomorrow at the close, and you would get the expiration price at the end. Now, people say, well, it sounds like you're cherry picking because you're just picking a high. I'm not. I'm trying to show people that there is this range. Ultimately, there is a life in an option. In that option can only go to 0. It can go from 0 to some level, whatever that level might be. If anybody is going to tell you that they're going to capture the high, or this option went up 1,600% or 800%, and we made all that money, and if I took these 5 trades, well, we can turn 5,000 into 400,000. It's not possible. It is not possible for you to get in at the low and get out at the high, ever. It's not possible. You'll do it once, maybe 3% of the time, if you're great at it, okay? What we do at Options Geek is we have a plan to extract from the middle. So the point is to show you the range, and we're trying to extract from the middle. The average maturity is 2 months. Holding periods can be as short as 1 week. I try to stay away from ETFs or indices, but occasionally I'll use the SPY, and you see the SPY and HYG I took down on the Monday after the first move lower in February. We trade options generally on equities, and again, outside of the indices. Now, I made my first public presentation in New York in March of 2019. These are the estimated monthly ROIs on all the trades we took from March to February, and you can see the returns. I'm using the same dollar amount on each trade I give. Okay, we have stop loss strategies that I teach, and we have exit strategies that I teach. Okay, you can get all this in my free membership. You can not only just see these are the results, but you can actually see every trade we took over the last year. I can tell you since February, March is probably tracking around 25% positive. April, probably tracking around 18% positive. May, tracking about 60% positive, and June tracking right now at about plus 15 positive. Okay, I don't show that because there's still some live trades there. Once they are done, I'll reveal all those trades as well. If you want to see all the trades, I have in my free membership, you have this book called Catching the Crash, How to Create Great Risk Reward Options Trading Ideas. And you can get that with all the, month to month, you'll see every single trade we took. Now, let's put things in perspective. There are options courses out there that go from free, which is the OIC is free, and it's good for what it gives you, the information it gives you. It's just not complete, and it's somewhat mismatched. But you can get that for free, or you can go out there and spend $15,000. I've seen courses even higher than that, but to me, it's silly. It's all the same education, frankly. It's all the same education. Okay, some people do it a little bit better than others, but it's all the same. Now I want you to think about average hourly results hourly rates for professionals in other industries. For a doctor in New York City, where I live here in New York, Westchester, $1,500. A lawyer, $1,000. Accountant, $500. Plumbers, $200, up to electricians up to $100 per hour. Okay, per hour. I built the Options Geeks 3 Steps to Profit for a one-time payment of $397. That's 20 plus years of my experience for $397. You do get lifetime membership for that one-time payment. You get lifetime access to the options tool that's giving you data, and you get 1 month free of Winning Picks subscription, and you can cancel at any time. Send me an email. You can cancel those Winning Picks. The way I come up with the picks and the analysis that I do and give to you, that's educational as well. So people use that to show them, and for me to show them what they are striving for. Now, if you don't believe what I'm saying, and that's fine, okay, I want you to go ask any expert what the questions I've been telling you to ask. Go ask them those 2 questions. You'll see people panic. Okay, in front of your eyes, you'll see their demeanor change. You'll see the questions and the answers that I gave you that are wrong, and you'll see the deflection tactics. But if you don't believe me, and that's fine, I have a free membership that I think you'll learn more in my free membership than what you'll pay for most option products out there. I have webinars, ebooks. I have an actual course that I give to beginners on Wall Street that I give you there. It's 22 minutes for beginners. It's called Bonus Step Number 1 Value. I have quizzes to take. If you can get by the free membership and you like the way I teach, I leave it there to show you what value really looks like, and for you to get comfortable with me and my teaching style and how I present the topic. After that, you can decide on 3 steps, or some people just choose the Winning Picks. The Winning Picks, I charge $197 per month for my trading ideas, or $19.97 for the annual subscription. That is, the $19.97 is the best value I give. It includes 3 Steps to Profit, and I offer a satisfaction guarantee where I'm going to give you 50 trades that reach triple-digit returns, or I give you the next year for free. Okay, so that's that satisfaction guarantee. I also have one-on-one coaching available on request. You'd have to email me. Your money doesn't count with me. We have to have a connection. I will spend my time learning about you and getting to know you and seeing whether or not I even think you're coachable or not. And if you aren't, I can lead you to something else or another product or whatever. But sometimes it's not going to match. Coaching is a very personal thing, and in order to get the most out of it, one, I spend a lot of time customizing the process for you. But I also have to like you and have to feel like we're going to be on the phone for a while and on Zoom calls. We got to like each other. We got to get to know each other a little bit. I just got this today. You see at 11:56 a.m. I felt like the universe was telling me I needed to show you, but I get these all the time. Here's a thank you note from Matt Baker. He gave me at the bottom permission to use it. I just wanted to send you a note to say thank you. I came across your service from the San Francisco Money Show last year, back in August. After going through all the education from starting to track my trade starting in December, I have doubled my account, 25,000 to over 50,000 to now from June 20th from then till June 2020 in realized gains. Crazy to think I have doubled my account even through the returns on those that are up. Even through the crazy COVID-19 crash in the market earlier this year. I missed a few trades here and there, so my results should probably be even better. I still have some open trades where my returns on those are up over 100% and growing. I have enjoyed the fact of how easy it is, how easy it has been to scale my size of contracts purchased as my account has grown. Your service has been very successful for me so far. I look forward to the continued success of this program and the continued success to my portfolio. Thank you, thank you, thank you. I send them a nice message back, appreciate it. I want everyone to win. I might be the only business options business person out there trying to teach you how to do it yourself so that you can actually go on and do it yourself and save yourself some money. Some people just like me giving them the ideas. I understand there's the do-it-yourself trader that wants to learn how to do it, takes everything from me and just goes. And I'm happy with those people as well. Either way, my only goal is to make sure that you understand and that you're getting what you want. Again, this is the most important picture that you need to take away. I don't want you to forget this picture, okay? The top guys in the world are the yellow. They're the top 1%. And there's no education that teaches the retail trader, the average trader, essentially most people today, how they trade. That is the option secret. That is a well disguised secret that even the experts on Wall Street, even registered brokers, RIAs, actually investment bankers, they don't know the answer. Okay, and I can take a couple of questions. Anybody on? You can actually go to optionsgeek.com. Optionsgeek at optionsgeek.com. Right there, you'll see. You click on the website and you go to. You can take a look. Join as a free member first if you'd like, or just go get the 3 steps package. In the top menu, you'll see pricing. Questions? I'll answer anything. Yes, I'm seeing down the question. So do you use expected move in your calculations? The expected move is the target stock price. The thing about buying options is about leverage. It's about capturing that leverage. So the most important part, what I teach people to do is focus on the target stock price. If you're going to do your own ideas, you have to have the target stock price. The easy game is the unusual options activity game, right? Because you're assuming that the person who bought that option knows what he's doing. And if you pick the right option and it's these big, massive trades, then it's probably a shark, right? It's probably a shark. You don't know exactly who it is, but it's probably one of these top 1% guys. And you're assuming that they know how to pick. And that assumption is probably correct, okay? But if you want to do it on your own, you look at the market and you say, you know what? I like puts here. I think the market's going to come off. Okay, where do I think that's not good enough to just go in there and say, I'm just going to buy options. I'm going to buy puts. You need to actually have a target stock price. And then you have to have some process on how you got that. That's not options. That's not options teaching. That's more of technical analysis teaching. That's more of actually fundamental teaching. It's not options teaching. Okay, you need a target stock price. I teach that in the coaching. I show people how to hone in on that, but it's not options analysis. How many trades per month I see? I do, on average, you'll see for a whole year's worth of trades in the free membership in that book. You just download that book, but it's going to be around 11 to 15. It's not probably, it is, I would say last, in April, I think we only did 10. May we only did 10. So it's 10 to 15, call it, per month. Do I teach cash flow strategies as well? Selling options, essentially. I do not. The top guys in the world do not sell options generally, okay? There's systematic ways to do that. Selling options, teaching someone how to sell options is actually fairly simple, okay? But I do not focus on it. I could teach. I have one person who I coach who just wants to learn how to do it for income. What people don't understand is there's different ways to trade options for sure. You can buy options or sell options, Okay, but if you sell options, okay, it's this notion that you're going to make $1,000 a month or $2,000 a month by selling options without risk, or just because you're selling. It's just not true. It's just as hard to make money selling options as it is buying options. The difference is a mentality. Okay, it's a mentality. If you buy options, you're hoping to win 3 to 4 out of 10 times. You're trying to create a process to win 3 to 4 out of 10 times. If you're selling options, yeah, you're going to win 70, 80, 90% of the time, depending on which option you sell. But when you lose in one of those options, the market is pricing everything to take back that money. Okay, so you'll make 8 out of 10 times. The 2 times you lose, it's going to take back 5 once, 3 the next time. Guess what? You're back at flat. Okay, that's what's pricing in. That's what the market is trying to tell you. How about another one? Can a small options trader fraud the drawdown? Great question. Okay, in order to trade options, yes, you will need. I simply say people probably need at least $3,000. Is a general statement, at least. Okay, ideally customers have 20,000, 50,000. The more money you have. How much time do I have? I have 5 minutes. Let me explain something to you. Because a lot of people say, oh, small accounts, and how do you trade small accounts? Options are a probability game. So if you think you're going to come into the options market and win 4 or 5 times in a row buying options, you might, but you're well on the left. In the middle is you're going to win about 3 to 4 times. Okay, and you have to be able to absorb, a losing streak of 5 in a row. So the important part is that the math is going to work if you allow yourself enough times to play the game. Okay, enough times. How much is enough times? I'm hoping 3%, 2 to 3% per each trade gets you in the game. If you have $1,000, 2% is not enough, right? It's not enough. And $1,000, 2% is only $20. You're not going to even be able to buy one contract. So when I was first learning how to play poker, I bought a coach, and the coach told me, in poker, I don't know if people play poker here, but I'm going to tell you, in poker, he says you want to be, the reason the aggressive people win is because they are putting the pressure on their opponent. Okay, I took that as a lesson. I understood it. I understand how to play poker fairly well now. When I look at the market is your opponent. So when you have a small stack, a small amount of money, what is happening is that when you buy an option, okay, you're not going to buy the low. So that means it's very likely, highly likely, that you're not going to buy the low, that the option is going to go against you. Your initial buy, the option will go against you. That is the market putting pressure on you. That is the market saying, what are you going to do now? What's your tactic? What do you do? So we build strategies to sort of, market raises you, market is putting pressure on you because you're down money on your first buy. We are layering into the trade, and I have strategies on how to do that effectively. Okay. Now, when the market goes up, if you only are able to trade one lot, I usually try to tell people, look, you want to trade $500, $600 per trade. That might be 3, 4, 5 lots. If you can only trade one option, then you can only have one entry and one exit. So when the market jumps up and it's up 150% on good news, and the market, now you have put pressure on yourself because the market is putting pressure saying, what are you going to do now? Okay, you have to make that decision if you only have one. If you have several, which is why I teach people, we want to have several ideally, because we don't want to think. We want to have rules. We want to be rules-based, and we want to sell one when we're up 100, up 175, up 250. We just want to keep layering out, okay? And using that rules-based sort of approach keeps this notion of you're going to pick the market each time. I mean, it's too much pressure to figure out what's going to happen. People email me, especially when they're new, they email me 20 times in the first month. What do you think now? Stock's going up $2. What do you think? Should I get out? There's no way. I don't know. I don't know as much as you don't know. Nobody knows. Okay. So what we have is rules-based process to try to get us out of this trade and try to prevent the stock to go up 500% and then back to zero, because it will happen. And so the lower the stack, the less likely you will win at options. Okay. The lower the stack. Why? Because you don't have enough money to prevent to stay in the game, if you will. Okay. If you hit a winning streak of 5 in a row, you're going to make a lot of money. But if you hit that 2-3 losing streak, your $1,000 is going to go down to $600 or $500. You need to be able to withstand the pressure of losing a few times in a row. Any other questions? Somebody asked me, why don't you trade? I have one more minute. Why don't you trade? Sorry, in your training, do you teach the analysis? But this is a better question. In your training, do you teach the analysis behind the recommendations? Yes. To most people, that is the most valuable part of the program is my analysis. I don't just say, hey, buy this option. I tell you exactly what I'm thinking. I'm giving you the risk reward analysis. I'm trying to show you exactly what I'm looking at, why I think this is good. If this works, this will happen. Okay, these are the types of things that I try to train your mind to think just like I'm thinking, and just like the top guys in the world think. They think about risk reward. They don't think about the actual money. They think about, was it a good trade going in? Okay, and is the process sound? And then we let the math sort of work its way out. There is some management in the middle where you're taking stuff off, you're putting stuff on. But this is what, if you can get to the heart of that, if you can understand that part, everything else will work out. Last question. I think it's 2 minutes, 55 seconds. I'm sorry, 2:55 right now. So I got about 30 seconds before Dave comes in. I think that's it. Listen, if you have any questions, you can always email me at felix@optionsgeek.com. Felix@optionsgeek.com. I'm very helpful to anyone coming in, even if you're not a member just yet. I would like you to be a free member. I can talk to you for a little bit, but ultimately I'd like you to be a free member. Go through some of the material before you either start asking me questions. Some people like to attack me anonymously. I take any form of interaction is totally fine. If you don't believe what I'm saying and you need me to lead you in different ways, that's fine too.